What's up, everybody? Rob Gill, Epic Insurance Services, and we are here in the Profit Center discussing many different topics, going through many different strategies, understanding what your why is. And today the question is life insurance a good investment for retirement? I don't know if you're going to believe my answer. So when we look at life insurance and the word investment, right? Look it up. Don't take my word for it. But if you have an investment, there's the IRS tax code is attached to it. Whether it's short-term capital gains, whether it's long-term capital gains, and I'm going to pivot back, whether it's ordinary income. So the question becomes, is whole life insurance an investment? To me, the answer is no. However, whole life insurance is the staple, the safety net, the great equalizer, the financial Swiss Army knife that allows you to maximize and spend down all your money in retirement. So now when I look at whole life insurance and I understand the financial mosaic, and we talk about that from time to time, you have your qualified money, which is money that goes into pre-tax accounts. You have your non-qualified money, which is money that goes in with after-tax dollars. And they're subjected to the stock market risk. They're subjected to fees, lost opportunity cost on those fees, and short-term and long-term capital gains. And anything that's inside a qualified plan, 401k, profit sharing 401k, defined benefit, defined contribution, all of the alphabet soup of investments, they're subjected to ordinary income taxes upon distribution. So if you properly plan and if you properly diversify within and amongst asset classes, what you can do is use your insurance to really be able to manage the tax code. What do I mean by that? This is an important distinction. To us, if you have cash value life insurance that has a guaranteed rate of return by state law and by contract, that the cost of insurance isn't changing and it is all properly done, and now all of a sudden you're 65 years old, and let's say we're in the lowest tax bracket in history. Let's just say that happens during your age of 65. What that means is you could take a lot of money out of your IRA and 401k because you're in the lowest tax bracket. However, if all of a sudden we go back to the highest tax bracket, like we saw in 1948, right after World War II, in that scenario, you want to take the least amount out of those accounts and take as much as you can out of your cash value in your life insurance. So as we just talked about, where we understand that you can manage the tax code through understanding what products you have in retirement. A good thing to think about is if you're on top of a mountain and you look down, it's a lot easier to get down the mountain than it is to go up the mountain. And think of that about your money. For example, in times where there's market fluctuation, you may not want to take as much out of the accounts that are subjected to the stock market risk and accelerate what you take out of the insurance. Conversely, if you're seeing a market rally over 2, 3, 4, 5 years, you don't have to live off the interest of those assets. You get to spend those assets down. And what that means, while alive, God forbid if you did shuffle off this mortal coil, that death benefit that you have in your whole life will replace what you spend when you're coming down the mountain. If you're looking for more educational pieces in this space, and you want to either ask us a question because you're not ready to make a decision, feel free to ask questions. We will get back to you. We will shoot a video on any questions that you have. In the meantime, please subscribe below, and thank you for listening.